come to a very, very, very important part of this lecture, which is as well a hugely important tool, which is called net present value. Yes, I know you may be shocked by this formula. You will think, oh, this is hardcore mathematics. How we could deal with that? No. Don't worry. It's not so bad. We have just went step by step by bringing present to the future. Then we went step by step by bringing future to the present. Now we will do just the same. The problem is we will just bring quite a group of futures to the present. This is just this. It looks hugely complicated, but it's not. It just sums up our initial investment, which is meant like zero with minus C0, and then we discount every cash inflow that happens. We add it up, we sum it up, and then we have the answer. We accept if net present value is bigger than 0, and we reject if net present value is lower than 0. Having said that, I'm now just coming to the 3 projects. Just don't worry about this very complicated formula. However, you have to remember this. Anyhow, so this is the example. We have 3 investment projects. Project A, Project B, Project C. Please write down this in your paper, but please leave like double the size on your right side in order that we squeeze something after. Those of you who are extremely brilliant, you know already, we will squeeze the discounted flows. But this is what will happen. So we write down these projects, and we could see that these projects are quite interesting, because then we will discount it by in discount rate 10%. But what happens? Project A, they are all cost 10, but Project A pays back quite quickly, like 6 in the first year, 2 in the second year, 1. But then it goes down. Project B is actually other way around. It's 1, 2, 6, 2. It's sort of like more in the middle. And Project C is very different because it pays back quite slowly, like 3, 2, but suddenly year 5 it's 15 and year 6 is 10. Interesting project. But you might say, yeah, but it's year 5, year 6, it's 10% discount rate. When we use the factors, how it will look like? That is the answer. How it will look like? It will look like this. So I will leave you a moment to see how it looks like. Now you know how it looks like. So we have these. Let me explain this table to you. You are familiar with several figures, several numbers, or the concepts of writing this. So we have like 3 projects, A, B, and C. On the left side, we have this straight cash flows, but we have to discount it. So we have this discount factor, this sort of very first column is this sort of 1 plus R to the to n, and the next column is sort of 1 divided by that. You must know it already because we used it a couple of times in case of 10%. So it will be discounted by this column that is 1, then it's 0.909, then it's 0.826, and so on. So you could see that say in case of project A, we take year 1, it produces the flow of 6. But because we use 10% rate, we divide it by factor, which is there, 0.909. So, discounted flow, in this case, will be 5.45. Similarly, when we take in the same project A, the flow for the year 2, which is 2, and then we discount it by factor 0.826, we come to the figure 1.65. The same 2, nominal 2, that comes in year 6 has to be discounted by the factor 0.564. And then it's pretty obvious to present value, it's valued less because in present money it represents only 1.13. When you compare project A discounted year 2 and year 6, in both cases this is 2, but discounted is far less. Very interesting would be to see what happens in project C when we have this 15, which is discounted by 0.621, and it comes to the value of 9, only 9. This 15 in year 5, now it's worth 9.31. And this 10 in year 6, discounted by 0.564, goes to 5.64. So, looking on these columns, we could see that the discounted yearly flows are worth in like contemporary now money less. But then, as you remember this formula, now we add up everything in discounted cash flows for the project A in column A. So we add up minus 10 plus 545 plus 165 and so on, and we arrive to the sum of 0.91. We do the same in the column B, and we arrive to minus 0.29. And then we do the same in the column C, and we arrive to 12.21. What we do now? We have this, the first one is positive, so yes, we accept it. The next one is negative, the third one is positive, yes, we accept it. But the project B is negative, so no, we reject it. It's the same calculation, but shown in different way. So, what we do with these projects, how we deal with that. So, project B has a negative NPV, net present value, so it has to be rejected. And in A and C, the decision will depend on two factors. Are they independent or mutually exclusive? Or the amount of budget that we have for the investments. Like, if they are independent, and we have money for that, so, and they are both positive NPV, so both should be accepted. But if they are exclusive and we have only this 10 to invest, we cannot invest in both because we do not have 20, we have 10. So we select this one that has higher NPV. So the project C has to be selected because it has higher NPV. But if we have this budget for this, like we have like 11 million, and it means that we could select only one. So we select C. But if we have the budget of 31, then obviously project B is rejected because it has a negative NPV. but when they are independent, we could and we should invest in both. However, obviously, project A is comparatively less profitable like the project C, but they're both profitable, so we should do it. I hope you follow this, because now I would leave some time for you to calculate. I hope you remember, or you could calculate yourself these factors. So let's do like this. This is the example, and this will be with you for a certain moment, because this is the project. We have some money, and let's say that we have quite substantial budget, like say we have 30 million, but we want to know if we should invest in these projects: project A, project B, project C. Which one should be accepted based on NPV rule? We assume, maybe I have not written here, I did not say that, obviously for the easiness, the interest rate is 10%. So we will use the same discount factors and in the previous example. So we should decide on basis on 10%, should we accept any of these projects or reject? Please calculate now. I will give you a couple of minutes, because it's very important that we try to calculate. So take your time, calculate. I will remind you that on the right you will construct this column, or you will copy from the pages that indicate this, the tables. You have these discount rates. I may say them now, that for year 0 it's 1, for year 1 it's 0.909, for year 2 it's 0.826, or maybe I will, if you copied this, please make sure that you copied. I will return to it. We have these in this table here. So this is the column 1, 0.909, 0.826, 0751, 0683, 0621, 0564. As far as I remember, you photograph a lot of things, so you may photograph, and then we come back to the our example. Please make the calculations. This is a very interesting situation, because as you could see, in case of A and B, the figures are like other way around exactly, and in case of C, it's very big figure in the year 1, and then it goes down. It's very interesting how we should approach that. I hope you are doing fine. I hope. Please calculate, at least begin. You may try to work it out at home. Obviously you study at home, I hope. So this would be the example to study. I just look on the clock. So okay, how it should look like. So it should look like this. And you could see that we have this discounted columns, and we have project A, and when we add up all these discounted figures, then we come to net present value of 2.66. In case of project B, it's very interesting, because these big figures come late, so you could see this net present value has diminished substantially. It's 0.59. And in case of C, despite the fact that it's very big in number in year 1 and 7, but in next years gives only 1, 1, 1, 1. So suddenly, when we calculate the net present value, we come to the figure of minus 0.19. So what should be the answer? The answer should be like this, that projects A and B may be accepted because the NPV is positive. Project C should be rejected because NPV is negative. Let's have a look again. Yes, this is the situation, how it looks like. So this is a very good tool, very, very good tool. There's a couple of pros and cons. It has a substantial number of pros because it uses all cash flows. The previous approaches ignored cash flows beyond a certain date. But this one includes everything. And then it fully incorporates the concept of time value of money because it discounts cash flows. And then it's additive. The cash flow is doubled when then the NPV is doubled. It's quite easy. The only weakness, substantial weakness of this project is that this discount rate is sort of estimated. We have to make sure that we make a good estimation for future, and it's estimated very well because then it depends a lot. You could see that sometimes the figures are close to zero, so very much depends on discount rate or interest rate. This is the same, because then it constructs this factor, this discounting factor. And in the very last moment of part 5 of our lecture, you have done your calculations, hopefully, for NPV, because these are the same figures as we have had in our example a couple of minutes ago. But now the question is more complicated because the beginning, obviously we assume this discount rate 10%. We assume, we use for these calculations. Which product should be accepted and rejected basis NPV rule? But then we have second part of questions. If the cut-off period assumed 4 years, which one should be accepted and which one should be rejected based on the straight payback rule? And then we compare the answers. So this would be sort of thing that we will deal later during our live connection, or this would be something that we will deal on the seminar. Thank you very much for the attention. This was quite a lot of things today. Wow, we are all tired. Yeah, I understand. Please digest this. Please know all these things that are useful from that. We will continue in the same active pace. I am fully convinced that we will do it. So thank you very much for today.